Before you move your 401k, stop for a second. One simple rollover mistake could cost you thousands of dollars in unnecessary taxes and penalties. Most Americans don't find out until it's too late. In this video, you'll learn the safest way to roll over your 401k and how to protect every dollar you've worked so hard to save. Direct rollover versus indirect rollover. Why choosing the wrong method can cost you thousands. Imagine you've spent decades building your retirement savings. You finally leave your job, and now it's time to move your 401k into an IRA. Most people think this is just paperwork. It isn't. The first decision you make can determine whether your retirement savings stay fully protected or whether you accidentally create a costly tax problem. Many Americans don't realize there are two completely different ways to move a 401k. One method sends the money directly from your employer's retirement plan to your new IRA. The other sends the money to you first. At first glance, they seem almost identical. The money eventually ends up in an IRA either way, but the rules are completely different, and that's exactly where many people make an expensive mistake. Here's what surprises many retirees. If the money is paid directly to you instead of being transferred between financial institutions, the IRS generally requires your former employer to withhold 20% for federal income taxes on an eligible rollover distribution. That doesn't automatically mean you owe that tax, but it does create a major cash flow problem. Many people don't expect it. They open the envelope and immediately notice the check is much smaller than their retirement balance. That moment creates confusion, stress, and sometimes panic. Some people think money has disappeared. Others believe their employer made a mistake. Neither is usually true. The real problem is that they didn't understand how the rollover process works before they started it. And once the process begins, fixing mistakes becomes much harder. The smartest retirement decisions are usually made before any money leaves your account. That's why understanding your rollover method isn't just a technical detail. It's one of the most important financial decisions you'll make when changing jobs or retiring.
Now let's talk about the safer way to move your retirement savings. For most Americans, the best option is a direct rollover. Here's why. With a direct rollover, your 401k money moves directly from your former employer's retirement plan to your new IRA. The money never becomes payable to you personally. That one detail changes almost everything. Because the funds are transferred directly between financial institutions, there is generally no mandatory 20% federal tax withholding on an eligible rollover. Your retirement savings stay together from start to finish. There is no need to replace missing money from your own savings. There is no unnecessary tax withholding to recover later through your tax return, and there is far less room for costly mistakes. Before requesting the transfer, open your IRA first. Know exactly where the money is going. Double-check the account number. Confirm the name of the financial institution. Ask your new IRA provider for their rollover instructions before submitting any paperwork. If your former employer sends a paper check, read the payee line carefully. If the check is made payable to your IRA custodian for your benefit, FBO, it is generally still considered a direct rollover. Do not deposit that check into your personal bank account. Instead, send or deliver it to your IRA provider as instructed. Also remember this: every retirement plan has its own paperwork and processing timeline. Some transfers take only a few business days. Others may take several weeks. Follow up until you receive confirmation that the money has arrived safely in your IRA. Keep copies of every document. Save confirmation emails. Write down the date you requested the transfer. These simple records can make solving future questions much easier. Finally, don't assume every rollover situation is identical.
If your 401k contains after-tax contributions, Roth money, company stock, or other special assets, the rules may be different. A few minutes of planning before the transfer can help prevent mistakes that could cost thousands of dollars later. The goal isn't just to move your retirement money. The goal is to move it safely, correctly, and without creating avoidable tax problems.
Before you move a single dollar, slow down and make a simple checklist. First, identify exactly what type of rollover you're requesting. If your goal is to keep your retirement savings growing without creating unnecessary tax complications, a direct rollover is usually the safer choice for most people. Second, open your IRA before starting the transfer. Know where the money is going, confirm the account details, and follow the instructions provided by your IRA custodian. A little preparation can prevent weeks of delays and confusion. Third, never assume every 401k should automatically be rolled over. Ask yourself a few important questions. Will you need access to this money before age 59 and a half? Does your 401k include highly appreciated company stock? Are your current investment fees lower than what you'll pay in an IRA? Do you benefit from your 401k's creditor protection? These answers can affect your decision more than many people realize. Fourth, don't rush because you're changing jobs or retiring. Life transitions create pressure, and that's when expensive mistakes often happen. Take time to understand the rules before signing paperwork. Remember this, a rollover is not just moving money from one account to another, it's moving decades of hard work. One wrong step could trigger unnecessary taxes, penalties, or the loss of valuable benefits. One informed decision can help keep your retirement plan on track. Key takeaway: the safest financial decisions are rarely the fastest. They're the ones you fully understand. If you're planning a 401k rollover, don't focus only on where the money is going. Focus on how it gets there. That single decision could save you thousands of dollars and protect the retirement you've spent years building. If you found this helpful, share it with someone who's changing jobs or preparing for retirement. It could help them avoid a costly mistake before it's too late.
Your support motivates us, so don't forget to like, comment, and subscribe.